Coming up on Market to Market, rural America waits as a tariff deadline looms. Another round of exemptions pushes the ethanol industry to its limit. The U.S. leather industry stretches out for new opportunities. And market analysis with Naomi Bloom next.
I'm the hugest fan in the world of the FFA Creative.
Pioneer Hybrid International is a proud sponsor of Market to Market. Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.
AccuSteel, offering fabric-covered buildings specifically designed for the cattle industry since 2001. The next generation of cattle buildings. Information at accusteel.com.
Sukkot Manufacturing Company, providing equipment and buildings to store and condition grain to help farmers adjust to market swings. We build drying, moving, and storage equipment designed to preserve the quality of their crops. Sukkot Manufacturing, store now, profit later.
This is the Friday, August 16 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Delaney Howell. This signal by the bond market that a recession might happen has yet to reach consumers. According to the Bureau of Labor, the Consumer Price Index and core CPI rose 0.3% in July as gasoline and electricity prices moved higher. New jobs and higher pay helped consumers make those purchases as retail sales grew a strong 0.7%. Without the drag of declining automobile sales, the index climbed almost a full percent. However, Creighton's 10-state rural Main Street Index sank below growth neutral, indicating a shrinking rural economy. Most of the bankers surveyed say trade tensions were having a negative effect on their local economies. The U.S.-China trade war is fighting for the top spot on the things putting pressure on American farmers and ranchers. Joining it is the release of the small refinery exemptions list. Reuters is reporting the latest round of SREs was triggered by President Trump. Peter Tubbs has the details.
Pressure from multiple directions pushed the agricultural outlook downward this week. Less than a week after threatening to increase tariffs on more Chinese products, President Donald Trump reversed course and delayed a portion of those new duties on products popular with consumers. Those new duties will kick in after the Christmas holiday season is over. The 10% tariff on an additional $300 billion worth of goods would raise the prices for both U.S. importers and U.S. consumers.
We're doing this for Christmas season, just in case some of the tariffs would have an impact on U.S. customers, which so far they've had virtually none. The only impact has been that we've collected almost $60 billion from China, compliments of China. But just in case they might have an impact on people, what we've done is we've delayed it so that they won't be relevant for the Christmas shopping season.
United States Ambassador to China, Terry Branstad, reports that negotiations with China have been stalled since April.
In April, we thought we were pretty close to a resolution of the trade dispute, and then the Chinese reneged on a bunch of commitments they'd made. And after the meeting, the President Trump and President Xi in Osaka, Japan, we're back to the bargaining table. But unfortunately, there's a number of key issues. So we want fairness and reciprocity. It's critically important that we have something that's enforceable.
The Trump administration announced this week that the Environmental Protection Agency has approved 31 small refinery exemptions, or SREs, for production year 2018. The new set of SREs exempt 13.4 billion gallons of gasoline and diesel from being blended with biofuels. The total represents more than 7% of the volume set by the EPA in 2018 to comply with the renewable fuel standard. Farm groups and politicians from ethanol-producing states had pressed the EPA and the Trump administration to refrain from issuing SREs and follow the terms set by the RFS. At a time when ethanol plants in the heartland are being mothballed and jobs are being lost. It is unfathomable and utterly reprehensible that the Trump administration would dole out more unwarranted waivers to prosperous petroleum refiners.
They screwed us when when they issued 31 waivers, compared to less than 10 waivers during all the Obama years, and we thought that was bad. What's really bad isn't a waiver, it's that it's being granted to people that really aren't hardship, and that's where it ought to be identified.
Iowa Secretary of Agriculture Mike Naig believes the deluge of drama surrounding agriculture has the farm community fatigued.
They are optimistic, but there is absolutely a frustration. I think folks are tired. I think folks are tired of the continual seemingly bad news, and it's a lot of things that come together. I remain hopeful that we will get to a better place with trade, and that we will have some success restoring the intent of Congress to the renewable fuels standard, and that's what we're going to keep working on.
For Market to Market, I'm Peter Tubbs.
Leather shoes and jackets are some of the luxury items we're usually willing to drop a few dollars on. And more than one farmer has relied on a good pair of boots to get them through the workday. U.S. manufacturers of leather goods have experienced a decline in sales as cheaper faux leather products have hit the market. But the spirit of domestic producers remains undaunted. Colleen Radford-Krantz has more in our cover story.
Historians believe tanneries, where craftsmen turned animal hides into leather, first appeared at least 5,000 years ago in villages in the Middle East. Today, communities still gather together workers, such as these in Pennsylvania, to process cattle and other livestock hides using methods not so different from those used by their hunter-gatherer forefathers.
The tanning industry is one of the oldest industries in the world. It's a direct byproduct of the meat industry, right? And so as we harvest animals for meat, just like the Native Americans, we try to utilize all of the components of the animal. And so that skin is about 6 to 10% of the animal weight. And so if we can capture that and use that for other products, that helps keep it out of landfill.
But tanneries are becoming increasingly rare. While colonial America had a tannery in nearly every town, these businesses have been rapidly disappearing. The number of U.S. tanneries with 50 or more employees dropped from 86 in 1993 to just 22 in 2016. According to the federal government, water treatment and other improvements to protect human health and the environment were costly for some tanneries. Many closed, while others relocated to countries with lower-cost labor. More recently, international disputes and the growth in synthetic materials have also hurt the industry.
Leather is a natural product. It's breathable, it's flexible, it wears over time. With synthetics, they're typically petroleum-based, which is a finite resource.
The tanneries that have survived have done so largely through specialization or a focus on exporting. Tim Ng is the director of West Des Moines, Iowa-based CK International, which buys and sells pigskins internationally. Pigskin accounts for only about 10% of the world's leather. CK International helps connect U.S. packing plants with buyers of pigskin, mostly in Asia, who then use the leather in other products. The majority of leather is made from cattle hides and used in shoes and boots, but automobile and furniture use remains significant. Over 90% of cattle hides produced in the U.S. are exported, China being a key buyer. The industry exported a total of $1.6 billion worth of hide, skin, and leather in 2018. Yet this was one of the industry's lowest export values since the 2009 recession, and prices for hides remain low. Still, Ng is optimistic.
As we have more transparency into where products come from and as consumers demand that, I think the industry is really positioning themselves well to kind of be in play and be part of that discussion.
In Curwensville, Pennsylvania, The leather tannery, Wickett and Craig, brought dozens of jobs to town when the now 152-year-old company moved there from Toronto, Canada in 1989. It still employs about 90 people in the town of 2,500 and is one of just a few large U.S. tanneries remaining that use plant-based compounds known as vegetable tannins on the leather. Most use chromium tanning, a method introduced in the 1850s and viewed as the most efficient processing method. There is a small risk, if exposed to extremely high temperatures, that chromium can convert into a type known to be a carcinogen. U.S. regulations, however, govern proper disposal and water treatment for all tanneries.
Vegetable tanning is the oldest form of tanning. It all comes from tree bark extract. Those trees are grown for the tanning industry.
And while the chromium tanneries can process a hide into leather in a week, vegetable tanneries require 6 to 8 weeks from start to finish.
When you get a pallet of hides in, you have no idea what you have there. We try to turn it as much into a science so that we can be consistent. I mean, the cattle are never going to be consistent. Those are variables that every tanner has to deal with.
The Wickett and Craig Leather Factory processes nearly 5,000 cattle hides a month, most from Charolais, Simmental, and Limousin cattle because of the lighter colored hides. Cattle brands and any other imperfections on the hide reduce the value.
Most of them come from the Dakotas, or we get them from the Toronto, that eastern Canada region. So the farther north you go, generally the better the hides are because there's less summer, and hence the less bug bites, less scratching, and things like that.
Bressler says the chromium tanned leathers tend to serve the automotive and garment industries, while Wickett and Craig might have their thicker leather used in equestrian equipment, gun holsters, and handbags. Bressler says most Americans fail to appreciate the quality of work done in the U.S., regardless of tanning method.
They think genuine leather is genuine leather, and why should they pay $12 or $40, $50, $60 for a genuine leather belt that the leather came from Wickett and Craig when they can buy one at Walmart for $12.95? It's all about education in a way. And they're getting better. Why our product is superior, and why our customers' products are superior. That's important.
For Market to Market, I'm Colleen Bradford Krantz.
Next, the Market to Market report.
The August WASDE set fire to the trade as the funds liquidated positions, crushing commodity prices. All three major commodities managed to rebound from weekly lows. For the week, September wheat nosedived 29 cents, while the corn nearby contract plunged 39 cents. The WASDE, combined with good weather across the upper Midwest, sent the soy complex plummeting. The soybean contract was able to claw its way back for a 12-cent loss. September meal lost $3.60 per ton. December cotton expanded $1.23 per hundredweight. Over in the dairy parlor, September Class 3 milk futures lost 3 cents. A fire at a Tyson plant in Kansas cut prices in the livestock sector as October cattle lost $8.70. September feeders shed $6.07, and the October lean hog contract tumbled $4.98. In the currency markets, the U.S. dollar index added 69 ticks. September crude oil gained 40 cents per barrel. COMEX gold put on $15.90 per ounce, and the Goldman Sachs commodity index fell more than 4 points to finish at $396.10. Joining us now to offer insight on these and other trends is one of our regular market analysts, Naomi Bloom. Naomi, welcome back.
Hi, thanks, Delaney.
Naomi, we obviously had a big report this week that a lot of the trade was waiting around to see what happened. Was there anything notable that happened in the wheat market?
The biggest thing from the wheat standpoint was that actually demand was increased, and that was nice to see. Export demand improved, and then also wheat going to be used for feed improved as well. So those were supportive factors. However, the all wheat production number increased because yield was increased on this report. Therefore, ending stocks in the United States back over 1 billion bushels, and now globally we're back to seeing the largest carryout number for wheat around the world as well. So the wheat market is going to be under a little bit of pressure for the moment, again, primarily just because of the surplus of supply.
And of course, wheat has been moving very closely here in tandem with the corn market. Tell us about the WASDE report there for the corn market. That was shocking, I think, for the trade.
That was beyond shocking for the trade. First, I'll start on the demand side. And we actually lost 125 million bushels of demand for the new crop. We lost it in ethanol, we lost it in the food, seed, and industrial category, and we lost it in the exports. So that was an unfortunate event, but the bigger surprise, of course, was the acre number and the yield number. Acres for planted corn came in at 90 million, and trade was expecting it to be substantially less. That was on the higher end of estimates, and compared to the July and June number, it was up at 91.7, so a cut, but not at all what trade was anticipating. And the bigger shocker came from that higher yield number, especially with as late of a crop as this is. The yield number came in at 169.5, and we were at a number before of 166. So the important part to remember on how that yield was determined, because that was new this year. That was a new way that they were conducting the August numbers. And the USDA did four things. They actually called the farmer and asked the farmer, what do you think your yield is going to be? They used satellite imagery. They looked at crop conditions as of August 1st. And the last one, and most important, is that they're assuming normal weather from now until harvest. You're going to see that yield number change a lot going forward. My thought is that it is tremendously yet too high, and we're going to have a crop tour next week. Hopefully we'll see some truth out of the reports from that, because we actually have humans walking into the field, and usually that Pro Farmer Tour does a nice job of just cutting to the facts and giving us the information that we need so we can get a better grasp of what really is out there.
Absolutely. We've got a great question here from Phil in Dresden, Ontario, addressing the acreage number and also the prevent plant numbers that we've seen. He said, please explain the 90 million corn acres number from USDA and the 11 million prevent plant corn acres. How did they find that many acres and not lower their acreage number on Monday's report, I think is his question here.
Yeah, that was the shocker, because it was 11 million prevent plant acres on corn. And so the thought is that during the month of June, when the corn price started to work higher, that perhaps more and more farmers were going to take advantage of the higher prices of markets, and so therefore try to plant more corn. That is what the market industry is thinking. So that is what we're working with for the moment. It is important to know that the prevent plant numbers are going to continue to be updated and changed in the USDA reports going forward.
Naomi, when you look at the corn and soybean markets, they had probably the most banking on Monday's report. They were trading in a range before Monday. We saw a limit down in the corn markets. Soybeans also pulled back quite heavily. Where do they trade from here? Are they going to continue in that range pattern?
For corn, with the market getting that negative news on the report, the marketplace price was able to finish a head and shoulders formation on that daily chart. And so we reached the downside objective. We also filled a gap that was really important to reach and fill on the charts. And so now we are within pennies of the low from May. The 370 area is tremendous price support. In my opinion, we're going to be finding our low within the next 2 weeks. We could potentially find the low next week if the Pro Farmer Tour finds out a lower yield number for us. And so probably for the next 2 weeks, more of a sideways trading range, just until we can get some better confirmation on yield numbers. So I do think that the worst is behind us, is my full belief on that.
For the corn markets and for soybeans.
And for soybeans, a lot of uncertainty yet there too. And more of a sideways trading pattern, because the bean yields you really won't know until we get those combines rolling. But as late as this crop is, there's so much weather uncertainty that can affect things. And in Wisconsin, we have corn that just finally pollinated this week. And so that's not going to be even mature until the second week of October, which is past our normal frost date. So God forbid we see an early frost with this crop. And this is not over yet in terms of prices and in terms of yield. So there's so much to be aware of going forward. But I would say our harvest lows traditionally come at the end of August or into early September, so we're going to be forming the lows quite soon.
It sounds like you're implying that perhaps the soybean yield yet has to come down as well when we get into the harvest season here. Am I understanding that correctly?
I think it has the potential to come down, because you're really, really needing absolutely perfect perfect weather for the rest of August and all of September. And so the USDA kept the yield at 48.5. But if that yield comes down to 45 with the demand situation that we have right now, then you're looking at ending stocks that are back to under a half 500 million bushel carryout, and that actually is really supportive for prices. And then if we could actually see China doing some importing of our product, we have a supportive story to tell going forward. But I really do think the yield numbers are likely to come down before they have a chance to even hypothetically go up.
Okay, Naomi, we'll save the rest of this discussion for Market Plus. We've got a great question, a dairy question here, because you're our dairy expert on Market to Market, from Lynn on Twitter. They said, will milk prices ever get and then stay above $18 for Class 3 milk futures in the near future?
So milk prices had in the past few weeks been pushing higher up towards $18 for the moment is going to cap us for the short term. The reality is that we actually have had cheese demand that is really strong. The cheese prices are improving. In fact, we had the black barrel price this week, the highest it's ever been in 2019. So there's some supportive demand from the cheese side of it. And milk production is down a little bit, in part because of lower numbers of dairy cattle. But I'm thinking, and what I think some of the trade is maybe interested and nervous about going forward is the feed situation for the dairy cattle, just because we don't necessarily have the feed quality that we're used to having with this late planted crop, and that could affect production going forward. So to see prices go above 18 and to stay above 18, I think is going to be dependent, of course, on continued demand. We need our export markets to pick up again because they're behind. And then we have to keep an eye on this feed situation because they're not going to necessarily receive the nutrition that they're used to receiving, and therefore production might be a little bit lower.
Okay. And their counterparts, the feeder markets, had an exciting week this week, to say the least, with the Tyson fire plants. Is that effect now factored into the markets?
Yeah, between the feeder cattle and the fat cattle having their just demise in pricing this week because of that plant fire, I think that the worst is behind us. The market was assuming that because of the fire that there would be cattle that would not be able to get slaughtered in time. Therefore, we'll see cattle needing to be slaughtered that can't get slaughtered, and it's a backlog. So that was why the market sent prices lower, limit down, and then expanded limits down. But that, I think, is really behind us because as of, so Monday, Tuesday, Wednesday, Thursday of this week, slaughter was actually only down 13,000 head from a week ago, which is about a 2% drop. And I have a feeling that production overall this week is not going to be cut as much as they're thinking, because there are other plants who are happy to work a little harder and fill their shifts, and by golly, maybe even work Saturday and do some overtime on Saturday. And I think by the time everything is said and done, we're not going to lose as much production as what the market is anticipating, because we have Labor Day orders that have to be met, and beef demand overall is still strong.
What about when you look at the hog markets? We had a limit down day to finish the week up here. What happened?
Market just continues to not be sure of what it can grasp onto for reality at the moment. It's concerned about the true thought that production is ample right now. We're concerned about lost demand for the export market to China, yet we found out this week that our exports were fantastic for this week, up 48% from the week prior, and half of our purchases were from China. So they are still buying from us, but it's not, of course, as much as they were buying in March. So prices now are back to the levels that we were at before the whole African swine fever erupted. So now we're going to be at a point where we're going to decide, okay, how much is our production actually going to be? Where is our demand at? And we're going to most likely, in my opinion, trade sideways for a little while, maybe a little lower, because production is big. But ultimately, I don't think it's going to get too much lower, just because I think that China's going to end up buying more than what people are thinking.
Well, and that's the question, is we kept hearing, oh, China's going to make all these massive purchases. We saw a good-sized purchase happen last week. Is there ever going to be a point in time where they're making these huge purchases in the market?
I wonder if it'll coincide with early October, late September, early October, when they have their big festival to celebrate the country, because that is going to be primarily, I'm thinking they're going to use a lot of pork during that celebration. Then they have their Lunar New Year celebration coming up in January. And with their prices up over 60% now, with demand for pork within China still strong. I think you're going to see them buying from us, not as much as we want until we get the trade deal nailed down.
Okay.
But still buying.
All right. Naomi Bloom, thank you so much.
Thanks, Delaney.
That wraps up the broadcast portion of Market to Market, but we will keep this conversation going on Market Plus, where we'll answer more of your questions. You can find it on our website at markettomarket.org. Using Twitter allows you to stay in the loop with just a few characters. We share news, pictures, and behind-the-scenes information on our feed of @MarketToMarket. Join us again next week when we explore why land rights activists view a new policy as more of the same. So until then, thanks for watching. I'm Delaney Howell. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Pioneer Hybrid International is a proud sponsor of Market to Market. Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.
AccuSteel, offering fabric-covered buildings specifically designed for the cattle industry since 2001. The next generation of cattle buildings. Information at accusteel.com.
Sukkot Manufacturing Company, providing equipment and buildings to store and condition grain to help farmers adjust to market swings. We build drying, moving, and storage equipment designed to preserve the quality of their crops. Sukkot Manufacturing, store now, profit later.